I want to show you a great little daily bar setup today, which I learned from Larry Williams. And Larry calls these setups smash days. I've found they can be great for identifying reversals, and they often pick the tops and the bottoms of short-term trends. I first discovered these smash day setups in Larry's book, Long-Term Secrets to Short-Term Trading. And if you want to read about them yourselves, they're on page 132 of my book, which is the second edition. Now, Larry does talk about a couple of variations of the smash day setup, but in this video, I'm just going to be talking about the first, or the regular smash day setup. And rather than trading every single smash day, which does make money, I've also added a great little filter which improves the results further still. So let me show you what a smash day setup looks like, show you what the filter is, and then we'll go and have a look at the results. Smash day setups obviously use daily bars, and all the results you're going to see in my studies are going to be looking at daily bars for euro dollar. So what does the setup look like? Well, this here is a smash day buy setup, okay? And simply what we're looking for is we're looking at the closing price of the smash day, and we're looking for the closing price to be less than the low of the previous day. And you'll quite often see, as you can see on some of my charts, that the close not only takes out the low of the previous day, but quite often, like Larry points out, the previous 3 to 8 days too. Doesn't have to, but it quite often does. Once we've identified that smash day with the close lower than the low of the previous day, then we're looking to trade the very next day if the high of the smash day is broken to the upside. So we then, as soon as we see that, we place a buy stop order at the high of the smash day bar. And this is pretty much like a false breakout, because quite often when we're trading breakouts into trends, we're looking to buy new highs or short new lows. And that's exactly what's happened here, isn't it? We might have the previous 5, 8 bars, and then we've got a breakdown below all of those lows, and we've even closed below the lows. So that's a really strong sell setup. However, if that setup fails and we get a rally above the high of that smash day, then it's a very good signal that that breakout surely was a false breakout and prices are going to move in the opposite direction. And that's our entry to go long on the smash day. And of course, the opposite for shorts. For shorts, we want to see, for a smash day, we want to see the close above the high of the previous bar. And then on the very next day, we place a sell stop order at the low of the smash day. So really, really easy to identify. Now, I'm going to be using a fixed pip stop loss, and I'm going to optimize and find roughly the best value for that. I'm going to test a stop and reverse type exit, which means that we're only getting out of a long trade when we get a signal to get into a short trade. And I'm also going to use a first profitable close exit with a day delay. So I might say, let's say we need to be in the trade for 3 or 4 days, and then every day after that we look to see if we're in profit, we exit the trade. If we're not in profit, we stay in the trade. Okay, and I'm going to be optimizing to see which day delay works the best. Now, also I want to explain that filter, because we could be taking every single smash day, which does make money, and I'll show you that on the chart, but I've included this filter which improves results even better. Now, let's look at the filter for a long trade. So to take a long trade, what we want to be doing is looking at the day prior to the smash day. So we're looking at this bar here, and we want to look at the high. And let's say that we're looking at a look back of 2 bars, for instance. So the rules will be, what we want to see is the high of yesterday less than it was 2 bars previous. Okay, so what it means is that we're in a bit of a short-term downtrend, and pretty much the opposite is for short trades. However, for short trades, we're looking at the lows. So we're looking at the low of the day prior to the smash day in comparison to the number of bars in our look back period. Now, I've said 2 is our look back, but we're not going to use 2. We're going to actually look, we're going to optimize to see which one is best. I thought to start the test I'm going to use 10 days, but when I've done the optimizations, I've gone from 5 days through to 30 days to see which one works best. And actually, the shorter periods, anything between 5 and 15, tend to work best. So hopefully the rules are clear, the exits are clear. Now let's go and have a look at the results on the computer. But before we do that, if you like this kind of rule-based strategy and you haven't got it yet, download my 22-page Beat the Markets strategy guidebook, and it's got 3 more mechanical or rule-based strategies, a bit like this. And at the moment, if you use the link in the description down below, you can get that for absolutely free. Let's go and have a look at those results. I'm going to show you each stage where I adjust the inputs. And first of all, we're going to use data from January 2010 through to January 2020, and then that's going to leave us 2020 and most of 2021 as out of sample or untouched data. So once we've optimized the inputs on the big chunk of data, the in-sample data, we can then apply them to the out of sample, the later data, to see, and hopefully the strategy will continue working. And then after that, I'm just going to show you, I won't show you the ins and outs of it, but I'll show you the results of a walk forward analysis as well. So let's have a look at the smash days. In this first workspace, you'll see trades here: short trade, long trade, short trade, long trade. These are all taking smash days without any filter. Now you can pause the video and have a look at the bars to identify what the smash day looks like. Let's look at this one here, for example. This bar here is a smash day. The close, which is here, is less than the low of the previous day. Okay, so as soon as we got that smash day, we place a buy stop order at the high of the smash day. If you look, the next day, we've got the blue arrow, it's just there where we actually hit the buy stop and we got in the trade. If we look at this bar here, this is also a smash day. Look, the close here is less than the low of the previous bar. So what we would have done is placed a buy stop order at the high of the smash day. But look, the next day, the market never reached that high, so there was no trade. Here's a short smash day setup here, because the close is higher than the high of the previous bar. So then we set a sell stop order at the low of the smash day. And look, the next day, here we go, we opened a trade at the low of that smash day. This previous day here was also a smash day because the close was higher than the high of the previous bar. So we would have put a sell stop order at the low of the smash day, but obviously the market never reached down there until on this smash day here where we got the trade. Okay, so pause the video and you can have a better look at the smash day setups. So we're just about to look at the performance report, and this is using data from January 1st, 2010 to the 1st of January 2020. With no filter or no stop loss. We're just a stop and reverse. You can see we're always in a trade. We get out of a long trade into a short trade, out of a short trade into a long trade. And that's what the equity curve looks like. Not great, but it definitely is making money. Look, we're making $42,000. And by the way, I've got $60 of costs for every trade included in this study. So that's just the results for the stop and reverse strategy. Okay, so the first thing I want to do is to add a stop loss. So I'm going to show you, I'm going to actually run an optimization in front of you for a stop loss. And we're going to go from 0 to 600 pips in steps of 50. So let's run that. Looking at the net profit, the best is actually at 250 pips, that's 0.025. Below that at 200 is pretty good. Above that at 300 is pretty good. Above that 350 is pretty good. I'd be more happy around about 300. So I'm going to select a 300 pip stop loss and look at the results to see what that's like. So now we can see our largest losing trade is just over $3,000, $3,060, including the $60 worth of costs. There's the equity curve. It doesn't look much different to having no stop loss. Now let's add that filter, looking at the highs and the lows compared to the highs and the lows of the look back amount of bars. And to start with, I'm going to use the look back bars of 10, okay? We're looking at the day prior to the smash day and then comparing that to 10 bars back. There's the equity curve, which is looking a lot nicer now. We're making more money at 61,000. Slightly less trades because they're filtered. A very good average trade. Percent profitable, 54%. But maybe 10 isn't the best look back bars. So let's run an optimization on the best look back. We run an optimization from 5 bars through to 30 bars in steps of 5 bars. And we can see look back here, 5 bars, 10 bars, 15 bars, and net profit. Quite clearly see that the best is actually 5 bars, not 10 bars. So let's select 5 bars. Percent profitable's gone up, average trade's gone up. We know that the net profit has gone up because we saw that in the optimization. And the equity curve is much nicer. That's really quite a nice equity curve, isn't it? Looking at the close to close new highs, that's pretty good. But what if we want to get out of trades a bit quicker and maybe improve the percent profitable? Well, that's where the first profitable close exit comes in with the day delay. So let's run an optimization and see if that improves things. And I'm going to run the optimization from -1. That means we're not using a day delay whatsoever, and then it'll go from 1 day through to 15 days. And looking at the net profit, we can see using no day delay or no first profitable close exit does work best in terms of net profit. And it's not until we start to get up to 77, 75, 77, some of these numbers around here are the best other than using none at all. And you'll notice it does bring the percent profitable up. It increases the number of trades, and it also decreases the maximum intraday drawdown. Look, we're using 12 for the day delay and the first profitable close. We've only got a drawdown of just over $9,000 as opposed to nearly $14,000 not using the first profitable close exit. So let's select using the first profitable close with a 12-day delay. Now we're getting out of trades much quicker. We know we've got higher percent profitable, average trade is slightly lower. We've got more trades. Average trade in bars is much lower. We know we're making slightly less net profit. And there's the equity curve, which is really quite nice too. So next I'm going to introduce that extra 2 years worth of data. Now I'm happy with some of the inputs, and let's hope that it does continue to perform in that out of sample data. But before we do that, if you're enjoying this video, then please do me a favour and give it a thumbs up now. Now let's add the extra data. So we're going to go now from January 2010 through to as much data as I've got, which is in December 2021. We'll see that on the chart. We can see we've got data here right up until, what's that, the 12th of December. And there's, looking at the equity curve, we can clearly see that we're making new highs into that out of sample data. So that's really good too. Now that's with the first profitable close. Let's just remove that first profitable close because the stop and reverse exit also worked quite well. And we're also making new highs with just a stop and reverse exit too. So that's really pleasing. Now I've already mentioned that I've done a walk forward optimization or walk forward analysis on this too. And if you want to learn how I do walk forward analysis, I'll leave a link to a video where I show you how most of the time I use walk forward analysis. So check out that later if you want to know how I do it. I'm using 4 years in sample, 1 year out of sample. And I can only show you the walk forward results from 2012 through till the present day. So I'm going to switch the data on the development we've just seen to go from 2012 so we can compare it to the walk forward analysis too. So in this workspace we have the walk forward analysis on data from 2012 right up until December 2021. And that's what the equity curve looks like, which obviously isn't as pretty as the one previously. In this study, using the walk forward analysis, for each year, I'm changing that look back period, that day delay on the first profitable close. Sometimes I'm using first profitable close, sometimes I'm not, depending on the best net profit value of the prior 4 years. And I'm also changing that look back period on the filter. And generally, walk forward analysis does give us a better idea of what live trading might look like. But the equity curve is going up, and we are making $33.6 thousand over that period. Comparing that to the previous study, and we got the same time period now, we've got 65,000, so we're not making anywhere near as much in the walk forward analysis. But like I said, sometimes it does represent live trading a little better than this kind of a back test. Well, I think this is a great little entry technique. And remember, Larry wrote about this decades ago. I'm not 100% sure whether smash days were in his first edition of the book, but the first edition was actually written in 1999. The next thing I'd like to do is look at some different filters. You've seen the filter I've used, and it was pretty much the first one I tried, and it worked, so I ran with it. However, I do think that that can be improved upon. And of course, I'd like to test more markets, more FX markets in particular. And also mentioned that Larry has a couple of variations of smash days. So perhaps in a future video, I'll show you some markets that the other variation will work on too. Let me know if that interests you. Leave a comment in the comments down below. Anyway, that's all for this video. I hope you've enjoyed it. And until the next one, this is Jared Goodwin, and thank you.